Hi everyone and welcome to this lecture. After learning how to set up your ads, in this lecture we are going to discuss how to read your ads results and how to analyze them. If you want to really optimize your business, understanding data is a key element. If you have a good understanding of data, it will be very easy to you to take your business to the next level, and it will also be very easy to know if you are profitable or not. I'm not sure if you have already tried running some ads, but whether you have tried it before or you are going to start now, analyzing Facebook data could look like a real nightmare. Facebook offers too much details, too many numbers, and they all seem weird and tough to you, especially if you don't like numbers and math was never your favorite thing. Well, don't worry, I'm here to hold your back. In this lecture, I will explain to you what are the most important metrics you should focus on in order to optimize your store. This will help you get rid of any frustration and will make dealing with Facebook data way easier. So let's start. Let's begin with the most important metric, the CPP, or the cost per purchase. If you remember well, we have talked about margin, which is equal to the difference between your selling price and the cost of the product, which means that if you are selling a product at $39 and the original price of the product is $20, then the margin is equal to 39 minus 20 equal to $19. So if the CPP is less than $19, you are profitable. And if your CPP is more than $19, you are not profitable. Comparing your margin to your CPP is the most accurate indicator you can use to know if an ad is good or not. If your margin is $20 and your CPP is $8, well, this is great. If your margin is $100 and you already spent $30 on ads, that doesn't mean that your ad is not good. You are still able to spend more on ads in order to sell this $100 margin product. So if you end up with a sale after spending $75, which means that your CPP is $75, it means you are left with $25 in your pocket, and this is great. But imagine that your margin is $12 and your CPP is $17. Well, that's very bad. You are losing money. If you are not a data fan and you don't like to spend lots of time analyzing data, you can only use your CPP and it's sufficient. But if you want to analyze your business more and if you want to boost it further, you need to look at more metrics, like the CTR, for example, which is equal to link click-through rate. It's the percentage of times people saw your ad and performed a link click. In other words, it's how many clicks you get when 100 persons see your ad. A lot of people ask me, which CTR is good? Well, the question is a little bit complicated because it depends a lot on your niche, on your product, on your ad copy, and on your audience. But as a general rule, a CTR less than 1% is not good. Again, if your CPP is good, then don't worry and don't kill the ad. When the CTR is less than 1%, it means in most of times that you should change your target audience or enhance your ad. Or it could mean that your product is not relevant. A CTR between 1% and 2% is considered good, but you should aim to do better. A CTR above 2% is considered very good, and a CTR above 5% is considered excellent. Another important metric is the CPM, cost per 1,000 impressions. This is a metric that measures how much you are paying to reach 1,000 persons. Using this data, you can compare your ad sets. If one ad set is costing you much more than others, you should figure out what to do, either to fix it or to kill it. Again, if your CPM is big, but your CPP is good, don't kill your ad. You should expect a higher CPM in the fourth quarter, especially in North America and Europe, because as you all know, at this time of the year, there are a lot of occasions where people buy products to gift them. Another important metric to consider is the ROAS, which stands for Return on Ad Spend, which is equal to the total sales divided by total ad spend. Let's see an example. If you spend $1,200 to advertise for a certain product and the sales were $3,600, then your ROAS is equal to 3,600 divided by 1,200, which is equal to 3. Which means that every time you spend $1 on Facebook ads, you generated $3 on sales. But the ROAS is not sufficient to measure your success because this formula doesn't take into account the cost of your products. So, imagine that the products cost you $2,500. Add them to the $1,200 on ad spend, it gives you $3,700 as cost for $3,600 in revenue. It means in this case you are not profitable. What we should measure is the ROI, which is the return on investment. Your ROI is equal to sales minus cost divided by cost. If your ROI is positive, it means you are making money. If it's negative, it means you are losing money. So if you make $20,000 on sales and you have $5,000 as cost, it means that your ROI is equal to 3. It means that for every $1 spent, you made $3 profit. Another interesting metric to look at is the relevance score. This metric measures how relevant your ad is for your audience. The more your relevance score is high, the less CPM you have. So you should always aim for a relevance score higher than 6. Now, if you have a relevance score equal to 3 and you are making money from this ad set, just leave it running. At the end of the day, it's the profit that you are making what really counts. Now let me show you how to keep track of these metrics on your Facebook business account.